Hi, I'm Roger Aguinaldo, and welcome to the M&A Advisor podcast. Since 1998, the M&A Advisor has been the definitive source dedicated to recognizing achievement, delivering unrivaled thought leadership, and connecting the world's mergers and acquisitions elite. We help you sharpen your edge and accelerate your success in deal making. Whether you're an ambitious new player or a market veteran, this podcast provides masterclass strategies, unvarnished stories, and vital lessons from the industry's influential figures. Before we launch into this episode, be sure to follow us on YouTube, Apple Podcasts, and Spotify, and subscribe to our essential M&A Alerts email newsletter. Find all the links below. Your engagement fuels the deal-making community. Now let's get into the transaction. Great, David. Thank you for joining us here, closing up a long day here at the M&A Advisors Future of Deal-Making Summit. We met down in Palm Beach, down at the Turnaround Awards.
That was a wonderful event and highly recommend it to anyone who's never been.
Okay, great. Can we use that testimonial from you? Okay, terrific. Elliott Management, many of you who don't know, is identifies as a large hedge fund investor, and your role is senior portfolio management and head of restructuring at Elliott Management. Just share with people what that is, and then I do want to talk about sort of your journey as you were recognized for the leadership award down at the Turnaround Award. So tell us a little bit about the day-to-day work you do over at Elliott.
Sure. Well, we have about $75 billion, in excess of $75 billion of assets under management now, and we pursue a multi-strategy approach. Most of that capital is in two main fund vehicles, both a domestic and an international vehicle with mirror portfolios. And, we have a very broad mandate that ranges from public equity situations, including equity activist situations, credit situations, both corporate and structured credit, and private equity as well. It's a significant business for us, commodities trading, real estate, and I serve on the investment committee, so I'm a little bit involved in that capacity in everything we do, but I'm far and away most involved in our stressed and distressed credit investing business. Okay, terrific. And the assets under management of Elliott? 75 to 80 billion. $80 billion, and in the distressed or sort of turnaround space that you manage? It fluctuates over time, depending on the opportunity set. So at any given point in time, we might have anywhere between a low single-digit percentage of our AUM allocated that strategy up to nearly half, in an extreme, kind of cyclical downturn scenario, like we saw during the GFC, for instance, of our AUM allocated that strategy. At present, it's a little over 10% of AUM that we have in stressed and distressed corporate credit. So about $7-8 billion that you focus on directly. Yeah, $8 to $9 billion of LMV in that strategy. Wow, that's incredible. Well, congratulations on that. We'll go a little bit deeper into some of the transactions and deals that you have done over the past. Very impressive past. A lot of good stories there. But I always thought what was always interesting is sort of how you got to where you are. Where did you go to school? I went to college at Harvard, and before that I went to a boarding school in Massachusetts called Deerfield Academy. Okay, and you grew up where? I grew up everywhere. When I was born, my father was still in medical school, so quite young, and we were living in Philadelphia. And then in the years that followed, we lived in St. Louis, Missouri, London, England, New Jersey, outside of New York City, Grosse Pointe, Michigan, which is a suburb of Detroit, Greenville, North Carolina, and then I went to boarding school from there.
Wow. Was your dad or mom a Army rat or something like that? Were you going?
Not at the time. My dad did actually later join the Army and just spent about 10 years as a doctor in the Army. Did tours of duty, a lot of different places. Afghanistan, Iraq, to name a couple.
Did you go with him? Were you
No.
in tow? That was later.
That was later. Yeah, I mean, he joined the Army in his 60s.
Yeah.
But when I was growing up, he was just doing different phases of training, internships, fellowships in different hospitals. He was always, kind of looking for the best, kind of opportunity to further his skills.
Okay. And he was a doctor? Did I?
Okay. A heart surgeon.
Okay. All right. Wow. Okay. So, and you didn't go medical, I guess.
I think when you have a parent who does something for a living, it helps you to figure out whether that's something that you would want to do. And I knew very early on, just from the fact that he would come home and talk about what he'd done at work, and it wasn't really that interesting to me. It's he and my mom.
So
would talk about
it was a heart surgeon. Is that what he did?
Yeah.
And so the blood, and that wasn't Dave Miller.
Not. I mean, I still sometimes get lightheaded when I see my own blood, let alone someone else's blood. But he loved it, and it was, I think it taught me a lot about working hard and giving your all at something. He would almost never be able to attend sporting events, little league games. He was always in the hospital on call or, rushing in to do some emergency surgery. The beeper would, always be going off seemingly. His skin was always like white as a ghost because he never got any sunlight. He just lived inside of, the hospital walls and emergency rooms and operating rooms. But it was, kind of a like good window into how hard you have to work to be good at something. Basically.
Yeah. You have any other siblings or?
I am the oldest of 5.
Okay. Wow. Yeah. Okay. So you have to set the example.
It's a lot of responsibility, but someone has to do it.
Okay. All right. Great. So, so you graduate Harvard, MBA. You got it.
No,
there?
Actually, I just went to Harvard undergrad, and I had at the time I had intentions of probably going to law school, and I decided to do a year in New York in investment banking while I worked on my application to law school. And really during that year, I figured out that while I had been interested in law in an academic sense, and I just I took every class I could possibly take about the law or that even touched the law throughout my time at Harvard, I realized that the actual practice of law was a little bit different and a little bit more oriented around relationships and client service. And it wasn't enough to just kind of be the smartest about the theories. There are all these other dimensions, and I didn't see myself as necessarily being as good at those other dimensions.
Okay.
In the course of my work in investment banking, I really saw that it'd be really cool to be involved in like making the decisions about what to do with capital and how to allocate it, and trying to pick the right companies that could possibly turn around and which ones couldn't. And we were in the business of providing advice on some of those things, but to actually be in the seat where you were making the decisions and kind of bore the direct financial consequences, good or bad, from whether those decisions were right or not. That was really exciting to me, and seeing other people who were in that seat, I was kind of jealous. So at the time, there weren't that many hedge funds. This was like in the early 2000s, and hedge funds were just kind of permeating the public consciousness, broadly, whereas previously they'd been more of a kind of ultra high net worth and kind of institutional phenomenon.
What firm did you work right out of? It was just
right out of Peter J. Solomon Company, or was called that at the time.
Yeah.
I think it's since renamed itself to Solomon and Company.
Yeah.
Elliott was the first place I interviewed. I went to a headhunter. Actually, sent my resume out to a series of mutual funds, almost none of which even responded. But one of my friends said, "Oh, I've been working with a headhunter. You should talk to them." I talked to the headhunter, and her first recommendation was, "Well, you should interview with Elliott." So my first interview was with Elliott. After months of interviews with seemingly everyone in the firm at that time, they eventually made me an offer, and I accepted, and I've been there ever since.
Wow.
Yeah.
Well, congratulations on that. So you were an analyst over at Peter J. Solomon.
Yeah.
And after your 2-year stint, you're going around, and you didn't want to go back to get your MBA. I guess that's the normal track.
Yeah, I think I
the usual track, I guess.
It wasn't a case of not wanting to go back. I definitely wanted to go back, but it never made sense to actually do, because the opportunity cost of leaving the role that I was currently in was always very high relative to the value in my mind of going back and getting the MBA. And so I always kind of waited for the right moment to do it, and that moment just never came.
Because you were already at Elliott at the time.
Yeah, I was always up to my eyeballs in cool stuff that I was doing, and all these different trades and deals, and so there was never like the moment where there was like a natural pause where I could just kind of like go and do the whole MBA thing. So I intended to do it, I wanted to do it, but it just never fit, basically.
So basically you grew up in and around the time, if you will, of Elliott and all the hedge funds.
Yeah, when I joined Elliott, we had $3 billion roughly of AUM. So it's been our growth over that time period has not been totally out of line with the growth of some of the other largest hedge funds. But nonetheless, it's been there's been a lot of additional assets, additional headcount. We've deepened our skills and improved our teams, and but the core culture hasn't shifted at all. From the time that I joined, and Paul remains very active in the business today.
Yeah. So $3 billion at the time, and what were you doing when you first joined Elliott? What were you working on?
Sure. So when I first joined, I was an analyst, and we had a different model then, than we do now. The model then was analysts are staffed with different portfolio managers on specific investments or specific deals, specific opportunities that would be looked at. And that gave me an opportunity to work on all sorts of different things. So on different transactions or investment opportunities, I was staffed with basically every portfolio manager that we had in the New York office at that point in time. And so I saw the full kind of range of what Elliott would do or could do or was doing. Now we have individual teams that are led by portfolio managers. And so if you're an analyst now, you just work with that one portfolio manager within the context of that one team. Oftentimes teams are more focused on specific industries or specific parts of the market. And they're not necessarily kind of roaming freely as generalists. And so I had a very broad purview into kind of the full scope of Elliott's investment activities, that be difficult as an analyst to get that today. Yeah.
Because of the scale you're at.
Because of the scale. But, we kept that model until the early 2010s, but there reached a point where myself and a couple of the other folks who were kind of overseeing staffing and workflow management, and who should work on what, and what analysts should we assign to which portfolio managers on which deals. The matrix we were working with became way too big, and there was I think a lot of we ran the risk of some real loss of efficiency, so in the early 2010s we kind of switched over to a team-based model, and I think there are just, when you reach a certain size, you have to do that, because you can't manage so many resources. There's a limit to how many resources you can manage in a centralized way. Yeah.
Do you lose out, or would some of the people lose out because they're not looking at deals sort of cross-sectionally?
I think there are trade-offs. I think our market has moved increasingly towards specialization. It's harder to be a generalist now than it was 10 or 15 years ago. I think 15 years ago in the distressed markets, almost everybody was a generalist. We would good and understandable reason, in that different industries would become distressed for different reasons. Then kind of the community of distressed investors would go and get up the learning curve and learn about that industry and try to get smart on it and begin deploying capital. And then cyclically, that industry might rebound and become less distressed, but some other industry would be becoming distressed at that point in time. So people would kind of roam, somewhat broadly across the investment landscape, from industry to industry. Now, I think as position sizes have tended to get bigger, I think the rise of LMEs, including coercive LMEs, the increasing importance of
What's the LME is?
a liability management exercise.
Okay.
The increasing importance of rights offerings and backstops, in connection with bankruptcy proceedings. These things can have real economic consequences in terms of the allocation of value within a capital structure. And just broadly speaking, you're increasingly vulnerable if you don't have a position that's meaningfully sized. And so that trend towards larger and larger positions, I think has made it it's provided an advantage to the larger players relative to the smaller players, in the kind of distressed industry.
Yeah.
And when you're talking about larger and larger players, there's more ability to specialize, right?
Well, you've done some pretty large and notable deals, even in your quote unquote earlier days. Enron, MCI WorldCom, TWA. Was this some of the things that you worked on?
These are things that Elliott.
Okay. Were you involved in any of those?
I was quite involved in Enron. That was a major labor of love for many years. That was one of the first projects that I became involved in when I joined Elliott.
Yeah. Okay. The sovereign debt, the Argentina debt. Did you guys work on that, or were you involved in that a lot? Okay. The sovereigns today, basically control the world, right? With a number of them, I would presume a number of them are LPs in your at Elliott, or
sovereigns or sovereign connected investors. Yes.
Okay. All right. How do you see the future of those sovereigns? They're just going to get bigger, aren't they? Control the world a little bit more.
I see no reason to think that the current trends will abate.
Okay. And do you have a view on that? Is there some of the assets, maybe pension funds, all of those others, are they going to be able to get access? That's from an access. I'm not talking politically. Your view on that, but sort of access to the best deals, or access to even to influencing companies, that sort of thing.
I think there's a lot of interest in access through co-investments, from that community, and the reason being that it's fee advantaged. Typically, the fees that someone will pay on a co-invest are often considerably lower than they'd pay in a kind of standard vehicle.
And they're hiring deal people within, so it's like they can underwrite these deals with high conviction, if you will, right?
Right. And then often for a co-invest, it's a promote, with little or no management fee.
Yeah. Okay. What about how does special situations? Maybe some of these. There's a lot of these private equity companies that are all special situations. You compete with some of them, or are you getting into? Are you sort of co-sponsoring some of those deals?
When you say special situations, do you mean the large, kind of private equity heritage asset managers and their push into the credit markets? Or
I see a lot of that going on.
Yeah, that's been it's been one of the defining trends, I think, in the last 10 years. Most of the largest asset managers that are publicly traded, they started life as a private equity firm, and most of those firms today, their credit business is both larger and more valuable than the private equity business is, and that's really a phenomenon that's happened in the last 10 to 15 years entirely.
Yeah.
But we do view those players as competitors of ours in the stressed and distressed credit space.
We only have about a minute left. If there are other questions from the audience, we'll have some of that. But I do want to sort of get your crystal ball of 2026 into 2027. Got the great Dave Miller here talking about from Elliott. What sectors, what parts of distressed do you think are going to be good places to invest or even to look at?
Well, when we're looking at that question, it's not just about what's traded off, but we also are looking to invest in things that have solid prospects into the future. Because there's a lot of things that will trade down, but they traded down for a reason. And I think we found a lot of opportunities in the last couple of years in the technology space, in particular. That's an industry that historically wasn't very highly leveraged. Those companies would raise capital through the venture capital community. They would generally keep unlevered balance sheets or largely unlevered balance sheets, and then at the right time they would go public. I think in many instances there's been a preference, even as those companies have grown, to remain private. And there's more capital formation now than there ever used to be within the private market. So there's not the same need to go public, as there used to be. And it's not the same, kind of cost of capital arbitrage that you used to see. And so in this last, kind of cycle, you saw a number of very highly leveraged balance sheets within the technology sector. That's a sector that's relatively non-cyclical. Often the business is sticky. If you have kind of embedded within your workflow some sort of technology platform, you're not going to be inclined to change it unless there's a compelling reason. So even when there may be a better product available, you might put off for some time, having to migrate everyone to that better product or service. It fits a lot of the criteria that we're looking for, as investors. Kind of relatively stable businesses if we can find them, and so we found that to be one of the industries that in recent months and it has been interesting.
Yeah. Any questions? I want to end with this, talking about cyclicality. AI and cryptocurrency. You doing anything there, or people say there's huge bubble waiting to be burst there. I don't know if they're asset values or whether you have a viewpoint on those sectors that seem to be sort of at a bubble level, if you will.
Yeah. We haven't done a lot in those spaces, and we're looking for opportunities that we can have high conviction in, and there's so many kind of factors driving those spaces, and they're so dynamic, we don't consider ourselves, while we're implementing AI in a number of different ways in our own processes, from an investment standpoint. We haven't targeted that as a specific theme, that we're trying to play, but we do encounter it, and it's relevant to all sorts of different companies that are in our portfolio. But I wouldn't tell you it's something that we're either deliberately avoiding or that we're deliberately seeking to exploit.
Okay, great. Well, I want to thank you, Dave. This went by very, very quickly, as I told you it would, right?
I enjoyed it nonetheless.
Okay. Well, I'm inviting you back down to the Turnaround Awards and the Distressed Investing Summit because, 6 months from now at the March 23rd, 24th down in Palm Beach. Can you join us?
I would be delighted to and look forward to seeing everyone there.
Okay. Terrific. Thank you, Dave.
Thank you.
We hope today's episode delivered actionable intelligence. We want to hear from the field. Share your questions or insights, leave a message on your favorite platform, or email us at editor@maadvisor.com. To secure your steady feed of premium M&A content, follow us on Spotify, Apple Podcasts, and YouTube, and subscribe to our M&A Alerts email newsletter. Find the links in the description below or visit us directly at our website at www.maadvisor.com. I'm Roger Aguinaldo, founder and CEO of the M&A Advisor. Thank you for being part of the M&A Advisor community. Until next time, stay decisive, stay connected, and happy dealing.